Welcome to the video summary series for Padisco's financial accounting textbook. In addition to chapter summary videos such as this one, financial accounting also offers podcasts, virtual tutor e-learning, homework activities with anti-cheat and auto-grade functionality, and detailed instructor resources. Find out more at padisco.com/finac. For now, over to the author.
Hi again, I'm Rachel White and welcome to the next summary in the Padisco accounting series. In this one, we're going to complete the accounting cycle, focusing on how to prepare a classified balance sheet, preparing closing entries, and summarising the accounting cycle. So let's start by looking at the classified balance sheet. In the last summary, we learned about the process of recording adjusting entries in the accounts. The next stage in the accounting cycle is to prepare the financial statements. Until now, we have prepared unclassified financial statements. But in practice, businesses usually report line items classified under different subheadings in their annual financial statements, which is why they are known as classified financial statements. The purpose of classifying each financial statement line item into additional categories is to communicate more detailed information about the business to users of financial statements. This chapter looks at the classified balance sheet, while the classified income statement is covered in the next chapter. In the classified balance sheet, assets and liabilities are subdivided into two main categories: current and long-term items. Current items are items that are due to be received or paid within 1 year, or within the normal operating cycle of the business, if the operating cycle lasts for more than 1 year. The operating cycle of the business is the duration of time between when the business acquires materials or services, uses them in their operations, and finally receives cash from selling their goods or services. Now, if an asset or liability is not classified as a current item, then it falls into the category of long-term items. These are items due to be received or paid over a time period that is over 1 year or longer than the operating cycle of the business. But rather than just talk about these classifications, we can look at the example of a classified balance sheet in our Padisco textbook. We can see that the balance sheet reports current assets, such as cash and receivables, as well as the long-term asset categories of property, plant and equipment, intangible assets, and long-term investments. Further down the balance sheet, we can see the balance of total current liabilities, as well as long-term liabilities such as loan payable and note payable. Finally, the classified balance sheet reports the balance of total liabilities and equity, which is equal to total assets reported earlier. After preparing classified financial statements, the next stage of the accounting cycle is to prepare closing entries. Closing entries are recorded in the accounts for two reasons. First, they reset the balance of the temporary revenue, expense and withdrawal accounts to zero. This is because each accounting period, we need to separately measure the revenues and expenses of the business to determine the net income earned. Closing these accounts each period allows us to measure the net income for each accounting period. The second reason we record closing entries is to update the balance of equity to include the net income, net loss and withdrawals of the period. This is because over the long term, the net income earned by the business is reflected in the increase in the overall equity held by the business. The first thing to do when preparing closing entries is to distinguish which accounts are to be closed at the end of the accounting period. Temporary accounts, which are also known as nominal accounts, are the accounts that are closed during the closing process. Temporary accounts are the revenue, expense and withdrawal accounts held by the business. Asset, liability and equity accounts are called permanent or real accounts because their balances remain open permanently, which means they're carried forward from period to period. Recording closing entries has 4 main steps. Step 1 closes the balance of revenue accounts to the income summary account, while Step 2 closes all expense accounts to the income summary account. The third step closes the balance of the income summary account to an equity account, and the final step is to close the balance of the withdrawals account to equity. The income summary account is a special account that is only used in recording closing entries. It is known as a clearing account because its ending balance is cleared or reduced to zero at the end of the accounting period, which is done by the third step in recording closing entries. Now you may be wondering, why bother using an income summary account at all? Why not close the revenue and expenses of the business straight to equity? Well, there are 2 advantages of using the income summary account. First, using the income summary account allows us to directly calculate the net income or net loss for the period. A credit balance in the income summary account means that the business has earned a net income, while a debit balance indicates a net loss for the business. The second advantage of using the income summary account is that it avoids excessive detail in the equity account because only the balance of the income summary account is transferred to the equity account. So, enough talking about closing entries. Let's go ahead and actually record them in the general journal of a sole proprietor. The first step closes the balance of the revenue accounts to the income summary account. This is done by debiting each revenue account with its final balance and crediting the income summary account for the same amount. In this example, there was only one revenue account of the business. However, if the business had more than one revenue account, each account would be closed in this way. Step 2 involves closing the balance of the expense accounts to the income summary account. Each expense account in the ledger is credited to the value of its ending balance, resulting in each expense account having a zero balance. The sum of the expenses of the business is debited to the income summary account to complete the journal entry. Step 3 involves calculating the balance of the income summary account to work out if a net income or a net loss has occurred. In this case, the balance of the income summary account is a credit balance of $10,265, which means that the business earned a net income. The income summary account is therefore closed with a debit to the income summary account and a credit to the capital account for this amount. The final step in recording closing entries is to close the balance of the withdrawals account to equity. This journal entry consists of a debit to the capital account to reduce the amount of equity held by the owner of the business and a corresponding credit to the withdrawals account. Once the closing entries have been journalised and posted, a post-closing trial balance is prepared, which we can see in our Padisco textbook. The post-closing trial balance lists all of the permanent balance sheet accounts of the business and their ending balances. The temporary accounts are not included in the post-closing trial balance because they have zero balances after the closing process. The purpose of the post-closing trial balance is to verify that total debits equals total credits in the permanent accounts after the closing process. When preparing the post-closing trial balance, you should also check that all temporary accounts have actually been closed during the closing process and have zero balances. We have now covered the main focus for this chapter, how to prepare closing entries. One good way to practice recording closing entries is to use the Padisco virtual tutor questions. You will find many questions for you to practice preparing closing entries, such as this one, where you are required to close the balance of the withdrawals account. We can select the accounts to be debited and credited, type in the value of the journal entry, submit that, and now we get personalised feedback for our answers and an explanation for the question. Now that we know how to prepare closing entries, we can summarise all of the steps in the accounting cycle. The accounting cycle is the steps and procedures accountants follow each accounting period to record the accounting information of the business. Chapter 2 taught us how to analyse transactions from source documents, journalise transactions in the general journal, post transactions from the general journal to the general ledger, and prepare an unadjusted trial balance. In Chapter 3, we learned how to journalise adjusting entries in the general journal, post adjusting entries from the general journal to the ledger, and prepare an adjusted trial balance. In this chapter, we learned how to prepare a classified balance sheet, record closing entries, and prepare a post-closing trial balance. Finally, there's an optional step called reversing entries that some accountants choose to perform at the beginning of the next accounting period. However, since this is an optional step, we will not be covering it in this summary series, but reversing entries are covered in the appendix to Chapter 4 in your Padisco textbook. So that's Chapter 4, completing the accounting cycle. The key topics were how to prepare a classified balance sheet, preparing closing entries, and summarising the accounting cycle.